Hey guys, welcome to the Passive Investing Made Simple show, the show that we do live every Tuesday to help you learn the ins and outs of passive real estate. Today's topic we're going to tackle is smart scaling. Okay, how can active investors leverage passive strategies to grow and diversify their portfolio? Okay, so this isn't, maybe you are a passive investor already. Okay, you're going to learn, how to balance between the two in case you do want to add active holdings to your portfolio. But more importantly, if you are already have your active rentals, even if they're managed by a property manager, we're going to talk about how to start adding in some passive strategies, what that looks like, why you should do it, and then more importantly, how to get that done in a manner that is helping you scale smartly and not just, me trying to convince you that passive investing is the greatest thing since sliced bread. Okay, so let's dive in on that topic here today. Now, we do this session live every Tuesday to help you learn how to turn your active income and savings into long-term passive income and wealth. And so maybe you've tried to actually invest in a passive deal before and you're just like, I can't quite get comfortable with the investment, which may be a lot of my active investors that are joining us today. Or maybe you've actually invested in a deal before and then realized, oops, I made a mistake. I did ready, fire, aim. Let me go back to the drawing board. Or simply you just want to sharpen your skills. If that is you, you're in the right place. Now, if this is the first time we're meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. But more importantly, I walk the talk. I'm a partner in over $800 million of real estate. And that's actively, okay? So more than 6,500 residential units, 15 express car washes, 2,200 self-storage units. I've done the flipping, flipped over 5 million residential real estate. I've authored the book that tells about my journey, which is The Money for Tomorrow, How to Build and Protect Generational Wealth. And I love spending my time here with you, teaching you how to achieve similar results through passive real estate. Now, really the result you're after, what I'm after here in life, is not so much scaling the highest net worth portfolio, okay, getting the most highest valuation for my buildings. It's not about getting at the huge unit counts, okay? Those all are vanity metrics. Really, as a passive investor, okay, our result that we want is 100% control and choice on how we spend our time. And that's what I love teaching you how to do here. Now, if you're joining me today and you're trying to kind of like test the waters and figure out, hey, what is this Whitney chick talking about? I'm an active investor. I will never do a passive deal, but I wanted to hear what she has to say. I'm going to show you how passive investing is probably a very smart idea to complement your active portfolio. Okay, but we can actually help you do all this here at PassiveInvesting.com. We have over 380 million deployed through our debt structure, our debt fund structure. We have 1.4 billion assets under management in our equity arm of our investments, and we've made over 51 million in distribution to our investors. So if you want to learn more about us here at PassiveInvesting.com, join the Passive Investing Club. You'll get a one-on-one call here with me to discuss your investing goals. You'll get weekly educational resources, but most importantly, priority access to our open deals. And so you can scan the QR code you see on your screen or go to PassiveInvestingWithWhitney.com. Now, we are going to go through some numbers today. That was something that you as a listener shared with me. You wanted to see more case study, more numbers. How does the math actually work? We are going to show that here to you today. But it's not financial advice, legal advice, tax advice. Of course, anything that we talk about on the show, and quite frankly, anything that you read in any book, blog, here in any podcast, you've got to take that back to your own investment team, your board of advisors before making any investment decision. All right, so let's dive in. Scaling your portfolio with passive real estate. How do we get this done? All right. And this is, again, we're approaching this with the mindset that, you may either be an active investor yourself or you've kind of toyed around. You're trying to figure out, do I do active investing or passive investing? We're going to kind of break down that probably the answer is both. And I'm going to show you how. All right. So what is the difference between active and passive investing? Well, really, the difference between active and passive investing, we can come up with some like fancy formal definitions, the IRS definition, everything like that. But the key differences between actively investing and passively investing is putting two variables on a continuum. And that is how much time you spend and how much attention you spend for that investment. The more time and attention you're giving to an investment, the more active it is. The less time and attention you're giving to an investment, the more passive it is. Okay. Now, again, we have our IRS definitions on how we earn the money, but I'm talking about those two critical variables that we never get back. Once we spend our time, once we spend our attention, it's gone. We can't get that back. That is a non-renewable resource. All right. So that is truly when we're talking about the difference between active and passive investing, I really want to focus here. Okay. So when you invest passively, what you're doing is you're investing capital into professionally managed deals, okay, such as syndications, funds, debt structures, equity investments. And you're doing this to get a hands-off strategy to leverage other operators' expertise, okay? Again, you're doing this not only to get the return, but you're getting the return on the two things that you can never get back, which is your time and attention. So why balance active and passive strategies? Why having some sort of balance is so critical? Well, I used to be an active investor. I did live and flip and house hacking for the first 10, 12 years of my investment career. And then I scaled a 40-unit single family rental portfolio. And then I bought two multifamily buildings, held them actively. And then I became the GP on projects. I spent the large lion's share of my investment career actually on the active side. And I can tell you from experience that every active investor, they start off with great intentions, but at some point in time, as they scale, they're going to feel stretched thin, especially if you're still working a day job, right? Maybe you're, high income earner in your business or in a company, or you run your own business, you get stretched really thin. And it becomes harder and harder for you as if you're an active investor, for you to get good market diversification in your portfolio, good deal diversification, asset diversification. You've got $100,000 into one asset, whereas you could have $100,000 into 10 assets if you invested passively. And then more importantly, you get stretched thin where it's hard to get your time back. Okay. Without fail, every active investor has hit these inflection points and they have a choice. How am I going to scale? Is enough enough? Do I stop? Do I actually scale this as a business and hire people underneath me to get my time and attention back? Okay. Or do I take some of what I've built actively, take some of the equity off the table and start investing in other people's deals? Okay. And that last strategy, passively investing, can help free up time while accelerating your growth. Okay. Because if you hire somebody and start scaling your business like a business, your real estate and active investments like in a business, you're still probably going to be limited on market diversification, deal diversification, asset class diversification, because you're not outside of your own business. All right. Whereas if you start investing passively, even our managing partners, both of them, Danny Randazzo and Dan Hanford, they both invest in other operators' deals. Why is that? One, to get other reliable cash flow from other investors that are outside of their time and attention. They're getting scalability and they're diversifying into other markets, other deals, other types of asset classes to ensure their portfolio stability. And that's what passive investing can give to you, especially if you're an active investor trying to figure out, do I double down and build the business, or do I need to divert some of this active income, in my business into other strategies? That's where the inflection point I hit. I had a nice mini ATM going on here with my active holdings. I now needed to get myself out of the way and diversify. All right. So why might passive investing actually make sense for you? Because again, as an active investor, you can use passive investments, just to start small, over time to scale faster. across other operators outside your business, across other markets that you have no interest in personally expanding into other asset classes. All right. You should stay a genius in your zone, you know. It's not that you personally, you know, if you're in multifamily, that you personally need to now become the expert in self-storage too. Maybe you outsource and invest into the next express car wash operator, the next debt fund operator, the next self-storage operator. Okay, bring these operators into your fold. Okay. Also, as an active investor, you can actually learn by investing in other operators' deals. You can learn other operator strategies. Okay, so you're just now becoming a better investor. You're getting paid to be, you know, vicariously mentored by these other operators. And it frees up time for high value activities. In that way, you can double down on your own business, say like sourcing deals in your area of expertise, or maybe you have your own business. Maybe you have your active rentals, you have your own business that you're running. Maybe you push pause on scaling the active rentals and start harvesting that income and cash flow to go into passive investment. That way you can scale your business now. Right? Now, I can tell you example after example after example of investors that have come to me and they say, hey, Whitney, I've got 15 rentals, 20 rentals. I've got a small multifamily building. I'm burned. I'm done. I want to figure out how to take this active money and put it into a passive deal. But here's the thing, it doesn't need to be all or none, okay? I encourage you to think of adding in passive strategies earlier before you hit that inflection point where you feel burned. Now, here's just a quick little example of an investor of ours, a multifamily investor. They sold one of their multifamily buildings. They had $200,000 to allocate across 3 deals, self-storage, multifamily, and a debt fund deal. Now, combined across all those deals, they were able to kick off some pretty strong cash flows that supplemented their monthly income that they were bringing from their other assets. So essentially they took some of what I say, your active chips off the table and invest them into passive deals to diversify outside of yourself, diversify your income streams. But not only that, getting that one deal, that one multifamily deal off their plate actually freed up about 15 to 20 hours a week of their time. It was a huge thing, right? They were actively managing this. And so, and at the same time, they started learning about what, you know, as they continued to invest in their passive strategies, they started to learn what other operators were doing that they can incorporate back into their own personal active investing. But this requires a mindset shift. And here's the thing, most active investors think passive investing is cheating, okay? But here's the thing, it's not cheating, it's strategic, okay? We're not learning, you know, again, I've come from, you know, this school of thought. I'm like, heck, I'm going to do it all myself. Why wouldn't I? I'm going to do it all myself. I can do it. I'm quite capable. I can solve the problem. But when I learned that I could go further faster investing with other people and in other people, I realized that that wasn't cheating. That was actually strategic. I was going to make more money that way. So, but again, it's a mindset shift because a lot of active investors, you know, feel that passive deals are kind of like a compromise, right? Like, hey, if I had the money, I can go buy my own building and manage it and make more. But guess what? You got to calculate your return on your time, which we'll do here in a minute. Okay. And unless they decide to actually scale their business like a business and bring on a team or a bunch of VAs to manage everything and property management, they're still trading time for dollars. Okay. But really, what we want to think about is not so much my job is not to convince you sell that building and invest passively, but that passive investing can be a nice complement to take some of your active chips off the table and invest. Much like I would talk to a high income earner at a tech company or a doctor or a lawyer or, a business owner, I would say, hey, let's take some of your active income and start producing some passive income out here that doesn't require your time or attention. Same thing here as an active investor. All right. Oh, and I don't know, most of my active investors have probably read the book Buy Then Build. And passive deals actually allow you to buy into a business and allow somebody else to build it. That's the brilliant part of the strategy here. Okay. So let's get a little bit more tangible. Okay. If you're sitting here going, well, maybe active investments are for me, but tell me, what do I get from it? Well, just like you would everything in your own active holdings. Okay. Essentially, you're buying into a partnership, in our case, that's holding a piece of real estate. So you could still get high growth. In the case of our debt fund, you can also earn compounded returns. You can grow faster, grow your portfolio faster through diversification. You can also spread out risk. Instead of taking your hard-earned capital, large chunks of it, and putting it into singular deals, you can now take chunks of that capital and spread it out over multiple passive deals that are across operators, markets, and asset classes. So you get greater true diversification. But here's the thing. Hands down, across the board, no matter if you're active or passive, you definitely need to make sure that you've built reserves, stress tested assumptions, and ensure that the deal is stable. You would do it for your own active deals. You still have to do it with the passive deals. Okay. Whoop. So let's get down to kind of the brass tacks here. Return on investment, ROI of our time. What is our time actually worth? Let's see here. I got a little bit of pause in the video feed here. Let that catch up. For those of you here live, can you hear me? Somebody go to the chat box and just let me know. Hey, we're back. Okay. So awesome. Thank you guys for chiming in there in that chat. Okay. So when we're talking about active investing, and you're trying to sit here and puzzle it out, right? It's not just about cash on cash return. It's not about IRR. It is not necessarily about equity multiple on the deal. Okay. Yes, you will probably get higher returns if you actively manage your deals, if you're spending time and attention in your own capital to invest in your own deals. But there's one metric I can almost guarantee you that you're poorly performing on, and that is ROI of your time, or ROT. What is your time worth? And so this is where a few months ago, when we were creating our investment plans, I led investors through an exercise to look at how much they were earning within their active deals, within their passive deals, and then calculate how many hours they were spending on their active versus passive deals, and then trying to figure out how much income they were earning a month. Okay, so when I look at my ROI, my return, or ROT, my ROI on my time, my ROT, I wanted to kind of bust this myth. A lot of people say, I earn more on my active deals. I'm like, yeah, but when you divide it how much time you're going to spend, probably not. So here I modeled out somebody who's taking a 7-year glide path to retire just on note funds. Okay. So they started off investing at $500,000 at a 9% tier, and then eventually crossed over by year 5 into the 10% tier. All right. And this is just annual compounding. So they're continuing to reinvest their distributions back into the business. Their ROT over 7 years was actually $8,084 per hour spent. All right. Whereas for them to kick off this same amount of return, they would have had to spend probably 5 to 10 hours a week to get that. Okay, sourcing their own notes over time. All right, but what does it look like if we've got a 7-year retirement using equity? Okay. Now, again, you invest in a deal, say it kicks off a 7% preferred return. You've got your $35,000 annual distribution. We're kicking that back into the business over the next 5 years. Okay. Or, depending, maybe it's a Class A property and it doesn't cash flow as much. All of that is getting kicked off by year 5. Doesn't really matter. Here, year 5, when you calculate the time that it took for you to invest in this investment and just read the monthly updates and maybe ask a couple questions, this investor over the course of 7 years to build 1.4 million in assets, their ROT over those 7 years was $3,559. Most active investors, okay, would be spending, about 20 plus hours a week in order to get this type of capital from their investments, all right? So when we talk about return on our time, now what else are you going to do, right? You can do anything. You can now take that time and go actually back to your active holdings and continue to dive deeper into your markets, find more deals, you leverage more partnerships, all right? You could scale in a whole other business if you wanted to, all right? This allows you to go further faster through leveraging passive investments as a way to create stabilized cash flow and equity growth outside of your own portfolio. So how do we get started, right? Most active investors that I talk to, they're like, some of them are just burned, they're done, they're like all in, they're like, I am done with the active investing. I don't want to manage any more tenants. I don't want to manage any more property managers. Please, Whitney, help get me out of this situation. Others are like, I'm not quite sure that I'm ready to do this. Okay. There's a unique few out there that should be building their own real estate portfolios actively. We call them syndicators. All right. So how do we get this done, right? How do we take a glide path here? Well, I would always encourage somebody, start small, right? Maybe you just set aside 20% of your portfolio, maybe not even 20%, 10% of your portfolio to passive holdings. And you make a commitment to put that money aside every single year in order to go into somebody else's investment. Okay, we need to have a game plan to do that, and think about diversifying strategically, maybe with other operators, other markets, different layers of the capital stack. But also, let's think about it. What could we learn from that deal and bring back to your own active investments? So, in wrapping up, before we open up our Ask Me Anything session for everybody that's here today, when we're thinking about how to take that glide path from active investing to passive investing, okay? And maybe it's not a full transition. Maybe you're just saying, Whitney, I hear you, okay? You've made a really good business case. I'm committed now to diversifying my portfolio and making it 20% passive, okay? How do we get that done? Okay, here's a quick little checklist for you. One, review your portfolio and determine how many, what's your weight between active equity and active holdings and equity and passive holdings. Okay, go ahead and calculate that up front before you say, Whitney, you're smart, let's start doing this. Okay, then set your commitment in place. Okay, 10%, 20%, 30%. Okay, make a commitment to move those funds over into passive deals that kick off cash flow each year. Okay, helping you create greater diversification. And again, the key here is, start with what you're comfortable with. Start with small allocations, build confidence in the strategy. Now, once you've reviewed your portfolio, you've set your threshold commitment of what you're going to allocate into it, build your investment plan. Meaning, understand when you go into an investment, is it going to help you hit your income goals that you want to hit? Okay. What is your timeline? What is your risk tolerance? Okay. Get that investment plan built first. That way, when you're reviewing deals, you're interviewing the deal to make sure it fits your investment plan, as opposed to looking at the deal going, I think it's great. And then you add it to your investment plan, you go, ooh, I had too much in that one category already. I'd already invested 30% of my portfolio in Dallas. Maybe I shouldn't have done that. Okay. And then once you have your investment plan, now's the time to build those skills. If you're not already proficient at vetting operators, markets, and deals, that's your next step. Okay. Join us in our Passive Investing Made Simple boot camps, where we teach you how to do just that. And then, as always, make sure you keep enough reserves on hand to reduce your stress as a passive investor and an active investor, but also create more flexibility in your investment plan. All right, guys, if you're here live, don't go anywhere. We're about to start our Ask Me Thing portion of the show. But just remember, we do one-on-one calls with all of our investors here at passiveinvesting.com. So make sure to go to passiveinvestingwithwhitney.com. Again, we can hop on a call and make sure that passive investing is right for you. We can get clear on how you might use this as a strategy within your portfolio. You get access to weekly education and masterclasses, and again, priority access to our open deals.